Hey everyone, it's Lawrence Mack here, real estate broker out in Mississauga and Toronto, and I'm here again with my buddy Chris Mulder from Trideck Mortgage. Hey Chris, how you doing?
Good, Lawrence. Good to see you. Thanks for having me again. Looking forward to this discussion. What are we talking about?
That's awesome. Well, today we're going to talk about custom builds and financing for that kind of stuff. Because of the market as it is now, there's a lot of people who are looking for houses and maybe the inventory isn't quite there. And so they're trying to think about the different options for their existing home, whether it's to renovate it, do an extension, custom build, that kind of stuff. So I wanted to go through the different types of methods that we can improve our own home, and then hopefully you could tell me about the financing for that kind of thing.
Gotcha. Happy
So
to chat. So I think it's important, Lawrence, that we categorize maybe three types of renovations, right?
yep. So the first one would be, for example, maybe I wanted to renovate my basement or my home. Or my kitchen. That would be like the first one. The second one they hear a lot is they want to do an extension. For example, you want to build above the garage, or maybe you want to just have an extension up the back. So that'd be the second one. And the third one would be the full blown, I want a custom build. So then we'll talk about, whether we want to get a vacant lot or maybe our existing home. So let's start with, I want to renovate my kitchen.
All right. So this is the simplest one. And if you already own the home and you don't have cash available, then the easiest way to do this is via a secured or unsecured line of credit. So you would go to the bank, apply for the line of credit. They would, based on the amount of equity available in your home, they would extend financing to you. And that would be suitable to finance a kitchen reno, anywhere between $50,000 to $100,000, whether it's the kitchen, bathroom, basement, painting, flooring, windows, that kind of thing. So that's a very simple, very common way of starting renovations. Another option also is if you have an existing mortgage, you can refinance your mortgage to increase the amount. And in doing so, I think not everyone appreciates necessarily that when you do a refinance, there's an amount that you owe, I should say. But if you borrow more money, you actually receive that money as cash. So you can access the equity through your mortgage and receive cash to finance these things. And I'll also mention one other thing. If you are buying a new home and you have a limited down payment, there is a mechanism or a product called Purchase Plus Improvements available from lenders, which allows you to finance certain renovation costs when you acquire a new home, like kitchens, bathrooms, basements, these types of things.
Oh, that's pretty good. So if I buy a new home and I really don't like the flooring and I need, want to renovate the basement or something like that. So now there's like a certain package that you can do, certain financial type of help there.
Yeah, that's right. Because when you're buying, you want to have a certain threshold of down payment, for example, 20% down to avoid the high ratio mortgage insurance. So if that's your budget, you don't want to put less down and hold on to cash to do those renos because then it's high ratio. So through this Purchase Plus Improvement program, you are able to purchase with your 20% down and then extract some additional money from the lender, about $40,000 to $80,000 to do these reno expenses.
And you can also, I guess, just get could you get like a regular loan for this type of project as well?
You can, but when we say regular loan, we have to define exactly what we're talking about. But if it's a line of credit per se, secured line of credit, that's the cheapest money you're going to find. You're capped at 80% of the market value of your home. Mm-hmm. So if you're buying a new place with 20% down, there isn't enough equity for you in order to get a secured line of credit from your lender.
I got it. But if I wanted to upgrade my kitchen and refresh that, the cheapest method for that would be to refinance my mortgage followed by getting a line of credit in terms of, I guess, interest.
That's correct. That kind of stuff? Yeah, that's correct. The reason you don't necessarily want to refinance your mortgage, though, is because you have to pay a penalty to exit early. So it's the type of thing that we talk about usually when your mortgage comes up for renewal. We talk about what your needs are for the next 5 years. And even though you might not be doing the reno tomorrow, we say, okay, over the next 5 years, do you need access to capital? And we build a mortgage plus a line of credit hybrid product.
Okay, so
to
depending on the particular circumstances, you should talk to a professional like yourself and figure out what makes the most sense, right?
As always.
Okay, so let's go with number two. So number two is more like an extension. So typically speaking, the examples that I've seen would be people either want to do an extension at the back kind of thing to increase the square footage of their house, or the easiest, like low-hanging fruit pretty much would be to build a bedroom on top of the garage. That one seems to be pretty common in terms of an extension. So in terms of financing for that, what would you do to go about doing that?
Yeah, so I think it's important here to pause and talk about covenants, what we call covenants in the mortgage world. So presumably, if you own a home and you want to do this project, you have some sort of existing mortgage financing already in place. And when you have a mortgage, you have made 4 promises or covenants to your lender, and they are to pay your mortgage on time, to keep your property taxes up to date, to keep sufficient insurance on the property so that if there's a fire, it can, there's full replacement value there. And then the 4th one is to keep the property in a good state of repair. And so if you are doing some structural change to your home, whether it be, removing the roof and adding a 2nd story, or blowing up the back of the house to do an addition, the home isn't necessarily inhabitable, and you have now broken that 4th covenant. So there's some sensitivity around that. But if you want to undertake this type of project, then the most suitable way to do it is via a secured line of credit on the existing equity in your home. So it's important for anybody considering this type of project that they establish how much equity is available to them via a line of credit. And again, that is capped at 80% of the market value of your home. So for example, if you have $1 million home with a $400,000 existing mortgage, you're going to be capped at an $800,000 total financing on that property, which gives you access to a $400,000 line of credit behind your existing $400,000 first mortgage.
So in theory, you take the $400,000 to build an extension, and then for the covenants, whatever, that one should be okay. It's not that major, or is that how that would work?
Yeah, so you have to assess the risk. You should be advising the lender of your intention in practice. Very often, though, people do not do that. They embark on the renovation, see no evil, speak no evil. By the time the renovation is done, it's now improved the value of the home, and life goes on. It's better for everybody involved. If the lender does find out that work is being done on the home and you've now broken that 4th covenant, it then becomes an enforceable action that the lender could enforce the mortgage and call it in, which would be very inopportune at that time, because it's quite difficult to finance a house that has no roof on it.
For sure, quite difficult. Okay, so that's for extensions. And then, so the 3rd one would be, typical speaking, someone wants to build their own custom home. So they buy a lot in the middle of nowhere. In this case, just like some land. How would you go about financing? So financing land isn't really doable, right? Like that, like a bank doesn't give you a mortgage on some dirt in the ground, correct?
Correct. Yeah. So, financing vacant land is not easily done. It's not impossible, but it is really the domain of private lenders and difficult at that. So if we are talking about the purchase of a vacant lot and the desire to build, we have to combine it all into one. Mm-hmm. And the way to start thinking about this conversation is values. So you have the land value, the value of the vacant lot is your starting point. And your endpoint is the value of the as complete home. Once you've built your dream home on that piece of land, there's a value ascribed to it. Construction financing or construction lenders will finance typically anywhere between 65% to 80% of the value at any given stage from vacant land to complete. Does that make sense?
Yeah, makes sense.
And so it's really important to establish what that end value is. We determine then, okay, what is, depending on the lender, they'll cap the financing at 65% all the way up to 80%. The higher the loan to value, the more expensive the financing. I'll just mention that. And as the project reaches various stages of completion, for example, that the foundation has been poured, the frame is up, the roof is on, the interior is being worked on, the plumbing, electrical, right? All these things. As we progress through the stages, the lender will advance money to you based on the completion of that project all the way to 100% complete. And then once the project is 100% complete, you can now go to your bank or any A-type or conventional type lender to get what's called takeout financing. And you then replace the expensive construction financing with your final mortgage from the bank.
Okay, so basically there's two different types of financing here. The construction company will finance it based on the end product of whatever it is, after which point they're not really financing you anymore. And then a regular bank will you have to take a mortgage to like buy them out.
Correct. Yeah, because that construction financing is only designed for one thing, and that is to finance the stages in construction. They're highly specialized in it. Most Schedule A banks don't accommodate construction financing. They do have construction financing programs, but they're pretty picky and quite strict about the qualification and the rules around that, which make banks unsuitable for most construction projects. So we usually turn to these specialized construction financing companies, which are essentially private lenders. Because of that, the capital is more expensive. At the lower end of the scale, if the loan to value is very favorable, around 65% loan to value, then you're looking at financing in the 6% range plus 2% in fees. At the higher end of the scale, 80% loan to value, the financing costs about 9% plus 2% in fees. So it's quite expensive. And one thing also to mention is that as the project progresses, you actually don't make monthly payments on that construction financing. It's actually budgeted as part of the expenses, the same way you have an expense for lumber or labor or drywall. The financing component is also a line item in your construction budget.
Cool. So in this case, there's no additional like mortgage payments or interest payments. It's just like this giant credit card that just money goes into, and then you worry about it at the end of the process.
That's right. It's definitely accumulating. The interest is accumulating, but that is part of that, takeout mortgage. You want to make sure that you are in a position to qualify for that takeout mortgage to pay for all the construction costs plus all the interest costs when you go to your bank.
Right. So in terms of interest rate, you mentioned maybe 6 to 10% or something in terms of construction loan. And then at the time of this recording, we're talking maybe about 4% or something is what like a regular mortgage would get you.
Correct.
There. Okay.
Yep.
So just as a comparison, in case we're
way
in the future, and 8% is like, oh, that is amazing.
I hope not. We got big problems if 8% is normal, but yes.
Yeah. Who the heck knows, right? So I guess the second question is, couldn't I do the construction loan like indefinitely, or do I have to like buy it out from a regular?
Yeah, if you can get construction financing from the bank, if you meet all the strict criteria, then the bank then converts that construction loan into the final takeout mortgage. Mm-hmm. But I would say for probably 90% of the cases, there are two different lenders involved. One is that construction loan or construction financing, and the other is the takeout. So they're completely separate. And so for that reason, you would always be needing to qualify for that mortgage a second time round. And that's one of the comments that I typically make at this point, is that when we evaluate whether you should be doing construction financing, we need to really assess whether you qualify for that final takeout mortgage from the bank. Because the construction financing, the construction lender is going to lend you money to do the work. That isn't the issue. What is the issue is that once the work is complete and now you have a $2 million, financing that needs to be paid out, do you qualify for $2 million at the bank?
I see. And then that would be based on the family income and the salary and that kind of stuff to see if you
Correct.
can qualify for a regular mortgage at that rate.
Correct.
Okay, that's very good. So I think that gives a good idea for buying like a vacant land. So the last question, which I get a lot, would be to build on my existing home. Because for the people who are looking to do this kind of stuff, typically speaking, there aren't that many homes that they like, I guess, in terms of that would work for their family, whether it's because of the finishings or, or just like the location, that kind of stuff. And so I mean, let's put this in as an actual example. Let's just say a family has about like a $2 million home. They have a small mortgage on that, nothing big, but they have a lot of equity in the home. And they're looking to build the end product would be like a $4 million home. So maybe about $1 million worth of build, that kind of stuff. So what would be the process for that?
Yeah. So you want to establish a scope of work. I think step one would be to have a preliminary discussion with the builder to get an idea of what type of budget is involved in building out that dream home, just to establish it. And then we would work with a realtor like yourself, Lawrence, or an appraiser to say, as complete, when this project is done, what will the value be of this property with this quality of finish, with this number of rooms? So you want to make sure that the value is there. And then based on that end product, that final value, we can then build out different financing solutions. Presumably you would have an existing first mortgage, and we would find some hybrid combination of adding a line of credit that you can draw upon as needed for construction, or we can also combine it with some specialty construction financing as a second or third mortgage to get the project complete. Then once the project is complete, we consolidate it all together. Again, I'm going to pause here and just remind the discussion of that covenant detail, that we want the home in a good state of repair for the lender. Otherwise, they can call in your existing first mortgage. So you have to evaluate the risk involved. If you are fundamentally tearing down your home, rebuilding the walls, rebuilding the foundation, then you probably should be seeking proper construction financing. If it's more of an aesthetic interior project where you're keeping the existing walls and foundation, you can probably get away with a line of credit and not necessarily advising the lender of the extent of the reno.
Yeah, so if you're maybe just going down to studs or something like that, might be okay, depending on what it is. You have the foundation, the roof, everything's okay, just inside, just doing some stuff, as opposed to you're bringing it down the foundation, adding some more foundation and then rebuilding back up. There's no home to finance there.
Correct. That's exactly it. If the music stops all of a sudden and the lender goes, okay, we got to call in the mortgage, and there's no home standing, they will not be very pleased. Yeah.
So in this particular case, all that initial process, whether you're doing the builder or getting plans or architecture, whatever it is, that type of design, is that part of the construction financing, or is it typically people would start the process, line of credit, and just start the process of setting up that package, figuring out what the final value is, and then going to construction loan?
Correct. Yeah, you want to, the initial cost, I think the initial discussion is typically with a builder who can start to establish for you what the hard costs of construction are and the soft costs of construction. And so that would be an out-of-pocket expense for most people, just to get started. And sometimes builders provide free quotes. Sometimes there's a little bit of a fee involved. And then beyond that, once we've established the scope of work and an approximate budget, we can then make some informed decisions about what type of financing is required. And again, one key thing to think about is that in addition to the builder's quote for the hard costs and soft costs, one of the additional soft costs is the cost of financing in that project. So we want to make sure that that gets built in and that there's enough room in there for, if it's a 12-month project, that the interest cost can be covered during that time period.
Mm-hmm. And so, I mean, what happens if you can't qualify for the mortgage at the end of the day? Like, you built this thing, then all of a sudden, maybe you lose your job, or, your business goes belly up, or whatever it is, and all of a sudden you can't quite qualify as much as you could before. What would be the options at that point? Because the construction loan is done, right?
Yeah. Yeah. I mean, once the construction starts, that's like a freight train. It needs to be finished, right? Because you can't stop halfway through the project, because it does nobody any good. That's very dangerous. So there's a high incentive to finish the project, and work through any issues that arise to complete the project. At the end of the day, with a finished home that is brand new, presumably inside, and very desirable, if you cannot qualify, then it's a very simple solution. You have to sell. And so you would list that home of your own accord and try and get top dollar to pay out the construction financing. And if you don't do that, then the construction lender will do it for you and start to enforce the mortgage via power of sale or calling the loan in.
I see. So then, so the construction loan, you can't just hold indefinitely, right? I mean, it's sort of like, okay, good, I don't mind paying this interest, even if it's a higher interest, but I'm okay with paying this higher interest rate because I can't afford a regular mortgage, but I can't just do that indefinitely, right?
Correct.
Yeah.
There's a certain point in time where the construction loan will be called. There is a term attached to it. Very often, the way the construction loan contract is written is that X time period after completion, they expect to be paid out in full. And again, I mean, most lenders are sympathetic to how life can be complicated sometimes and will work with borrowers, but it is not designed to be an indefinite form of financing your home.
Got it. So they're not really there for the financing, they're there for doing the construction
That's right.
financing. That's about it. But then if there's construction issues in the middle, whether during COVID or like labor shortages or whatever, like, does that affect the loan?
It can. So one of the common clauses in construction financing is that if work stops, then the interest for the money that's been borrowed up until that point needs to be paid. And so when, there have been situations due to COVID, due to supply chain issues, where construction has had to stop, and construction lenders are working with their borrowers to establish, okay, can you pay the interest, or do we allow it to continue to accumulate? And it also depends on the length of time, because if the construction stops and it's indefinite in nature, there's a high risk there, and so the lender would expect payment on the borrowed funds. But if it's a systemic issue where we say, okay, well, this material isn't available, but in the next 3 weeks we expect it to arrive, typically the construction lender will be comfortable waiving that requirement for accrued interest payments.
I mean, so it sounds like if you're going to go embark on a custom build, you really want to make sure you have the financial backstop to support unexpected issues. Like if you're just borderline to afford this, it doesn't sound like it's a great idea. Is that correct? Like based on your experience?
Correct. You want an abundance of cash available liquid to you for overruns, because even though the lender does give you the construction financing, the timing of how and when money becomes available, because it's given to you via progress draws, the timing may not line up, and therefore you should have some cash available. Usually it's about 10% of the construction budget should be available to you, cash at all times.
Yeah, for sure. I mean, I was talking with one of my friends who was doing a custom build, and he was just saying, every change order that he saw, they liked, so pretty much the budget just kept ballooning, because I mean, they were building their forever dream home. So everything was
Yeah,
like, yeah, can we do this? Sure, why not? Right? Higher
yeah,
ceilings, yeah, that sounds good. It just keeps adding
absolutely.
up.
Absolutely. Yeah. I mean, and it's crazy because on a $1 million construction budget, what's $5,000 here? What's $10,000 there? It can get really out of hand quickly.
Yeah, so based on your experience that you've seen a lot of, families that have embarked on this journey of custom builds or that kind of stuff, like any recommendations you can give or like problems that you've seen, tips, that kind of thing?
Yeah. I mean, one of the things I kind of half jokingly say is that it's not as glamorous as you see on HGTV. It's a little bit more complex, right? Whatever your expectations are in terms of cost and budget, double it. Whatever your expectations are in terms of timing, double it, right? And it's an adventure. It's not a straight line. There are problems that arise that need to be worked through. There has to be a certain level of flexibility, and it's not for everyone. And I would say, especially if it's a couple embarking on this process, which often it is, that you're both on board and comfortable with that uncertainty that comes around doing these types of major projects. You don't know what you're going to find or what you're going to encounter on the way. And so you have to have flexibility and a good attitude towards it and good confidence that you can solve those problems. And again, it's not everyone's cup of tea to be dealing with those types of cost overruns or issues that can arise.
Yeah, for sure. It's not for the faint of heart. I mean, I've talked with a lot of people who have done custom build, and the process of like the 2-3 years or whatever it takes to get it done was very, very painful. Although they did like the end result, but I mean, even while I'm building it, besides the financial uncertainty of how much it's going to cost, you have to like live somewhere else during that time. So
Yeah.
whether you're renting, some temporary accommodation for 2 years, or you're living with the in-laws, it's not quite stable, I guess, for the household. So that process is really painful, but at the end of the day, a lot of them do enjoy their final dream home that they were going to live in for the next 20-30 years or whatever.
That's
So
right. That's right. Yeah. And it's not for everybody. It's not for everybody. And in the meantime, time is money. So it takes a long time. It can't be rushed. And in the meantime, you're bleeding cash for all the reasons that you said. You have to live somewhere else. Interest is accumulating. Things may not go at the speed that you expect. And so it's going to cost more than you anticipate initially. Always. It always does.
and also don't forget about the HST.
Oh, yeah, don't forget it. Yeah, and that's another one of those soft costs in there. Like everything is
That
plus
you don't
13.
really think about. It's like it costs you $1 million and HST.
Yeah, that's right.
Something like that. Well, I think that's all the questions I have today. Any other final suggestions, I guess, for custom build or for any of these extensions, that kind of stuff?
No, I think we covered a lot of it here, a lot of content in this call. And I would say if anybody has any additional questions or concerns about how to finance, the door is always open. I can be reached on my cell, 416-732-8020, or you can find me on my website, tridacmortgage.com.
That's awesome. Well, that's Chris from Tridac Mortgage. And again, I'm Lawrence Mack, real estate broker out of Mississauga and Toronto. We'll talk to you soon. Bye-bye.